Good morning, ladies and gents, and welcome to the January 2026 edition of the Blackfinch 10-minute market forecast. I hope you're all well rested after the Christmas break. I'd like to thank you for joining us today. My name's Jordan Kent, Distribution and Sales Executive for Blackfinch Asset Management, and I'm joined today by our Assistant Portfolio Manager, Mr. Josh Clayton. In these webinars, we explore key themes across the globe that are shaping markets, preparing you for questions your clients may well have about current events. If you have any questions during the session, you can submit them using the Q&A box, or alternatively, if you'd like to ask us directly, I'll be sharing our contact information at the end of the webinar. And before we begin, I'd like to note the information we cover is intended for financial professionals only, and so shouldn't be interpreted or taken as financial advice. Today, we'll be focusing on three areas: the United States, emerging markets, and China. We'll explore where growth is proving resilient, where optimism is building, and where some of the key risks are starting to make themselves known. With that, I'll hand things straight over to Josh to begin today's content. Good morning, Josh.
Thank you, Jordan, and a very good morning, everyone. Happy New Year from myself and the investment team here at Blackfinch. And as Jordan said, a warm welcome to the first market update of 26. So as we kick off the year, I thought it would be a good moment to do a bit of an economic stock check, meaning we're just going to take a step back, look at the state of play for some of these key players that are shaping markets as we head into this new year. So I'll start with the US. For the sake of the webinar, I won't go into geopolitics or views on Latin America or oil for now. Instead, let's focus purely on the economics. So despite plenty of headlines suggesting some slowdown risks, the underlying picture still points to a relatively robust economy. And the first chart we have on the screen here breaks down US GDP growth down by its main components. So your consumption, business investment, net exports, inventories, and government spending. And we know despite stellar returns global investment markets delivered last year, one of the key themes was volatility, whether that's regarding asset prices, geopolitics, and other factors. And it's no more evident than when we're looking at this GDP for the US. Liberation Day is largely left the headlines now, but it did make an impact. Thankfully, not as much as a lot of people had feared. But we can see pre Q1 25 that GDP was somewhat stable. There was healthy consumption and government components showing that strength in the underlying economy. But then what stands out with the post-Liberation Day effects? There were these volatile swings in stock building or inventory management from companies that were trying to get ahead of those tariffs, avoid additional costs. And that was very contractionary in net exports. And that talks to the obvious negative pinkish purple bar in Q1. But in the following quarters, that's reversed. There's been a continued downdraft in imports. And it's these noisy components that muddied the economic picture for some in the US. But if you just strip them out and focus on the core of the economy, the picture looks pretty stable. Consumption remains the key anchor. Consumer spendings continue to make a solid contribution to growth, especially on your services. And that tells us households are still spending, even as real income growth has slowed. And a big part of that resilience has actually come from wealth effects rather than pay growth. And that leads to a very important nuance. So what we're seeing is what's known as a K-shaped consumer, where higher income households are doing more of the spending, while lower and middle income consumers are under a bit more pressure. On the investment side, there's also a bit of nuance. Despite the hype around AI, there are parts of business investment in yellow that softened, and the underlying data showed some weakness, particularly around equipment and data center related spending, very topical, but it looks as though that may be temporary. So, quick takeaway, the US economy isn't booming by any means, but it's also not rolling over. Growth is supported by that domestic demand. And while quarterly GDP numbers may be noisy over 26, the core momentum looks reasonably solid heading through the year. From a market perspective, this still supports the idea of a soft landing type environment, but one where inflation risks or interest rate expectations can still drive volatility. It may mean we could see some growth or inflation shocks to the US economy with this kind of dynamic in play. And we spent a considerable amount of time in the investment team considering our own portfolios to make sure we're diversified enough to mitigate those risks where possible. We're still constructive on the use of equal weight indices in the US to counter that valuation argument and offer some more downside protection. And that was a positive for us in December, where some of these mega cap names had a bit of volatility. We also have a preference for focusing some of our risk budget on the emerging markets where prospects appear very attractive from an outlook and an entry point perspective. And that takes us neatly onto the next theme. So emerging markets where improving fundamentals are driving a more constructive outlook for 26. Now, if many of you have been watching the webinars over 2025, you'll know that this is an area that we've been constructive on and building a position for some time over the course of the year. And it looks as though the view for this year is no different for now. We're still getting foreign direct investment increasing, global capital flows continue to come into the market. And finally, broader investor sentiment has improved quite meaningfully over recent months. And importantly, that optimism is increasingly being backed up by some solid fundamentals. And the growth chart on the left side of the screen is 2026 EM GDP forecasts with the consensus expectations. And what's really interesting is that the forecasts have been revised above consensus, suggesting there's scope for upside surprises to growth and earnings as we move through the year. And that matters especially for the emerging markets, as their equities tend to perform best when growth expectations are rising rather than falling. But it's worth noting there's a bit of third-party information that Oxford Economics, who we've sourced the charts from here, are also supportive on the region. The macro colleagues have become progressively more optimistic on the outlook, as activity has been supported by some pretty resilient domestic demand. There's the AI-driven investment boom going on at the moment, and also trade rerouting away from the US towards China and some of the markets. And as I say, I'll come on to the China point in a moment. But this talks to this potential for earnings surprise, and that brings us onto the chart on the right. So this is just like a earnings revision chart, where it takes your earnings per share, which is, as a reminder, just a typical profitability measure. And it shows that the tech sector is leading this earnings upgrade cycle. And that's being underpinned and supported by that continued investment in AI related infrastructure and their supply chains. And that's why you'll see in the headlines a lot places like Taiwan and Korea continuing to feature in the headlines quite prominently. They sit upstream in the AI ecosystem, and they're seeing a lot of this momentum come through for the companies, with TSMC being the most obvious one. Valuations are also part of this story. Despite the rally we've already seen last year, EM tech valuations are still less stretched than the US counterparts, both in absolute terms and then relative to history. And following a bit of a recent pullback, things are slightly closer to long-term averages, even as profitability has improved. But China will be an important part of that role. More generally, their front-loaded stimulus can support activity further, while China's kind of export-driven disinflation can help keep global price pressures in check. And again, that's supportive for emerging market central banks and just financial conditions more broadly. So, in summary, continue to see improving growth expectations. There's strong earnings momentum in tech, and all of this is at more reasonable valuations. So a very credible case that there may still be more to come in 2026, albeit with a bit of selectivity. And all of this optimism around emerging markets does, however, have one caveat and one direct link onto the final theme that I want to touch on, and that's China and their growing role in trade and how that's shaping the backdrop. So rather than the traditional China slowdown story that you may have heard of, the focus is on their role as a global exporter and then how the rest of the world is responding. So trade frictions between the rest of the world and China are emerging as a key risk for 2026 and beyond. So while the US may have initiated all of these current tariff wars, it's almost feels now like it's largely in a phase of relaxation with China and taco style trade policy moderation. But by contrast, other countries are increasingly upping their trade restrictions on Beijing. China's current growth model remains heavily export dependent. The household consumption is still pretty constrained. There's a lot of weak confidence, and still the lagging property issues from 2022 have still taken an effect. And because of that, they've just relied on their manufacturing scale and the foreign demand for all of this growth. And it's just a clear export driven strategy for the rest of the world to see. And for Chinese leaders, all of these pieces are essential to power and the resilience with their manufacturing supply chain controls, and technological self-sufficiency, all of these strategic assets. And the result has just been this surge in exports across autos, clean energy, steel, machinery, and often at prices foreign producers just can't match. So by late 25, China's trade surplus exceeded $1 trillion. It's an unprecedented figure for a single economy. And it's shown by the two charts taken together. You've got your clear divergence between exports in blue, import volumes in red. Exports have continued to rise, imports have lagged, reflecting that reliance on external demand rather than domestic consumption. The result is this huge, massive surplus on the right-hand chart, and that's continued to widen. And from a global perspective, the key point here is this massive surplus doesn't exist in isolation. It shows up in pressures elsewhere. And that's why we're starting to see certain trade policy contagions. While the US may be in this kind of relaxation mode, other regions like Europe are very much becoming more vocal and quite active in defending their own domestic industries. And all of this does raise the risk of broader trade restrictions, greater policy uncertainty, and increased volatility in sectors exposed to global manufacturing and supply chain. So this is one of the key risks for us from an investment perspective. It doesn't automatically mean risk off by any means, but it just reinforces the point that the geopolitics, industrial policy, they're going to be really important drivers of returns, particularly at the sector level. So to pull it all together, the US economy shows resilience beneath all of this noisy headline data. Emerging markets are seeing improving fundamentals, particularly in tech-led Asia, with scope for further upside in 26. But then there's a risk to be aware of, and that's trade. China's massive scale and this export-driven growth model is becoming a more significant source of global trade tension, and this will shape dynamics throughout 26. So certainly remaining selective, bearing in mind markets can still be volatile. And as always, we're on hand if you have any questions that you want to field to us from yourselves or clients, feel free to give us a call. But on that note, Jordan, I'll pass back to you for the wrap up. Thank you, everyone.
Thank you very much, Josh. And thank you, folks, for spending your morning with us. Now, as promised, our contact details are on screen now. If you do have questions over the topics we've covered, would like our comments on topics we haven't covered, or if you'd like to discuss our range of managed and tailored portfolio solutions. But that does conclude today's session, and we hope you'll join us for the next instalment, which will be airing on the 3rd of February at 8:50 a.m. For now, from all of us at Blackfinch Group, I'd like to wish you all a pleasant day and look forward to speaking with you again very soon. Bye for now.